We live in a financial system obsessed with speed. Algorithms trade shares in milliseconds, and constant feeds of global information make us feel like taking immediate action is the only responsible way to manage our money. The problem is our biology. Human instincts were forged over millennia in environments where reacting instantly to sudden threats meant the difference between surviving and becoming prey. Our brains are hardwired to panic when gyms drop and chase when things run. Financial media and modern trading apps exploit that exact fight-or-flight hardwiring. They are engineered to manufacture daily urgency and excitement, bombarding you with alerts designed to keep you anxious, engaged, and constantly clicking. The very survival reflex that kept our ancestors alive under pressure is precisely the mechanism quietly destroying long-term wealth in the modern market. Warren Buffett built one of history's largest fortunes on unhurried stillness. He measures holding periods in decades, quietly watching while the broader market spins. He manages to shut off the biological urge to react, consistently opting for the hardest move available, doing absolutely nothing. Most people picture patient investing as sitting on your hands, but think of a farmer. All the active work happens during the preparation and the research. Once the seeds are in the ground, waiting is not passive at all. This chart shows productive inaction. While waiting, the business germinates, opening locations, acquiring customers, compounding value without your intervention. Compare that to the active investor. Selling triggers hidden friction. Taxes and fees fracture the smooth curve, slicing capital away. By never selling, you defer tax payments entirely. That capital stays in your account, feeding the compounding math uninterrupted for decades. The stock market operates as a ruthless sorting mechanism. It systematically transfers wealth directly from the active, impatient trader right into the pockets of the patient owner. The ultimate stress test arrived during the 2008 financial crisis, when global markets dropped by nearly half. Imagine holding a massive Coca-Cola stake then. As the market melted down, the psychological weight of watching your portfolio shrink day after day urged every nerve in your body to sell. Look at this model. If you own an apartment building where reliable tenants pay rent monthly, a newspaper predicting a crash doesn't change your income flow. The market price swings wildly on a tag out front, but the building's output remains intact. That's how Buffett viewed Coca-Cola. The fear-driven market price crashed, but the business was still quietly selling billions of drinks worldwide every single day. Surviving a panic requires the cognitive discipline to permanently separate the daily market mood from the underlying reality of the business you own. Holding a stock forever starts with radical selectivity on day one. Buffett operates as if he has a lifetime limit of 20 investment decisions, a hypothetical 20 punch card. When you only have 20 punches, you skip the good enough ideas. This framework forces you to endure the intense psychological discomfort of holding uninvested cash, sometimes for years, until you find absolute certainty. He found that certainty with Apple in 2016. While analysts saw a tech stock subject to rapid innovation, Buffett saw an inescapable consumer ecosystem. People were too locked into their apps and habits to ever leave. Berkshire held those shares through years of severe turbulence. They ignored the daily stock chart entirely, anchoring their conviction in the strength of Apple's business model. The patience to wait years before buying is just as vital as holding the asset afterward. If you overpay in a rush, you permanently damage compounding from the moment you hit buy. For the ordinary person, the most practical way to build wealth is to set up automated, regular investments. Removing the human decision entirely bypasses the instinct to react to the news cycle. But when the market inevitably crashes, the only thing that will keep you from selling is deep knowledge of why you own a specific asset. You can only stay still if you actually understand the business. Look at this timeline. Holding McDonald's shares through decades of recessions and food safety scares resulted in this exponential wealth spike. We live in a society that demands instant gratification and punishes slowness. In an environment that frantic, genuine, grounded patience is an extraordinarily rare advantage. The results come from the strength to stand perfectly still when the entire world is screaming at you to run.